Hey everybody, Josh Sigurdson, a World Alternative Media here, and of course we're joined by author and economic analyst here at WAM, John Sneisen, and as a new story has broken, biggest subprime auto lender skipped income verification on 92% of auto loans, and this story goes much deeper than just this, folks. John, can you go into this and explain this?
Well, of course, the banks are up to it again. They are dealing with their what they call now ABS, which is auto loan backed securities, just like mortgage backed
Yeah,
securities.
not IBS, though it's quite is similar if you think about it. But go on. I mean,
Total BS.
yeah, totally. And I don't think it's much of a surprise that the bankers are up to it again. When are the bankers ever not up to it?
Yeah, well, just as an well, of course, they call them the new center of auto finance, Santander Consumer USA, which is a Spanish bank. They have now, been providing these auto-backed securities to a lot of people, and they're looking at some severe losses coming very soon because they skipped 92% of all the people that they borrow money to. They didn't even care to look at if they had income or if they were able to pay it back, which is, well, I guess it doesn't matter anymore. Anyways. So this is just an example from the deal that this auto-backed security deal that they put out. It had an average FICO score. FICO score is your credit rating of 595, which is very low. It's subprime. And then they had an average loan to value of 110%. That should tell you that you should be very worried when you have a loan to value of anything. Remember, we were talking about houses. If you want to invest in it, most smart investors have a 60% loan to value. And when you have a massively depreciative asset as an automobile, as a car, you are stupid. That's all I gotta say about that. Of course, the APR, the interest on it was 16.2% over a 70-month term. So of course, I want to go quickly into auto loans, and we can talk quickly a little bit about the history behind auto loans. Now, auto loans before, they used to be, when I remember back in the day, 2-3 years.
Yeah.
Now, you're looking at 5, 6, 7, 8. I even have seen as high as 10 years. And it's getting pretty insane. Santander has, of course, issued $15 billion of these auto loans, which is $2 billion above the subprime mortgages that was with Century in the United States. So it's getting pretty scary. Now, of course, when it comes to an auto loan today, of course, inflation has a lot to play on how much an automobile costs today, which has gone up substantially. It's very high right now because people have to get into from the 2 to 3 years we were talking about back in the day. Now they're looking at 5 to 10 years on the other side, and people are not able to pay their auto loans. There's constantly people not being able to afford, and of course they borrow money out against used vehicles. Now 67% of all these vehicles that was borrowed against was used vehicles, so they're even faster depreciating than a new car, for example. The problem here is also that they're just blowing another bubble.
Well, I was gonna say, I think I hear some bankers blowing bubbles somewhere, John.
Well, it totally is. It's a complete bubble. We're looking at the same bubbles as they've been blowing in the housing market. And as people can afford less and less, they have to get more and more into debt. So that's why you see on the other side, these bankers taking a huge profit, 16.20%. And interest, of course, it's a massive high risk for them to borrow because they didn't verify the income of 92%, which is insane. But, of course, they have other lending schemes as well. And I think we touched very quietly upon it. It's called car title loans. Now think about the home equity line of credit that you have on different houses, a HELOC. Yeah. You could also have the car title loans, which means that you can borrow equity out of your car, which is depreciating. It just gets vastly insane how people are now, because their wages have been stagnant over the last 10, 20 years almost, people are seeing a mass amount of inflation, and the uprun in debt that we're seeing all around the world is basically because all of this stagnation in income that people have, and they have to get more and more into debt in order to afford what they could with the regular salary back in the day.
Well, it's hard to make accurate predictions these days due to the level of manipulation in the markets. The fundamentals are off the table. But John, where do you see this going in the next 5 to 10 years? It could even be next year. But in general, where do you see this going in the next several years?
Well, when they skip in all of these income verifications, and of course, just the massive debt uprun that we've seen in all asset classes, in credit cards, in auto loans, in student loans, well, any kind of loan that you can see out there. There's been a massive bubble, and of course, the central banks have been keeping interest rates low. Now, of course, the Federal Reserve has been hiking the interest rates slowly higher. The problem is now we're seeing that it's all coming apart because nobody can afford any longer this debt. And as the Federal Reserve slowly increments, they're totally collapsing the economy. What you would have seen in the old days, they would probably gone up 4 or 5% suddenly, but they can't because they've blown such a massive bubble out of historic proportions in mankind's history.
Well, the Federal Reserve just claimed today, actually, that they expect 1.8% growth over the next 10 years.
Okay, so how are you supposed to get more of these auto loans and get more growth? Because problem is they've been borrowing to so many of these people that can't afford it. And there's nobody else to borrow to out there. People can't afford to pay anything back anymore. Most people anyways. And what you're seeing is a complete collapse of the the whole fractional reserve banking system is collapsing in on itself as it over leveraged massively into all this debt. Everybody's getting into debt. You got, I forgot to mention, of course, the corporate debt, and how they've been buying back stocks with debt in order to prop up their prices. It's just insane, all these debt schemes and how they are monetizing debt in itself, of course, with all these derivatives.
Well, they always thrive off of debt. That's one of their biggest biggest agendas.
Yeah, debt, and then of course they collateralize all this debt and then sell it off their balance sheet, so they don't have to worry about the risk. They just put it on a pension fund. They might be AAA rating.
Well, they have AAA rating or something. They have a great rating on a few of them. They're good. For example, mortgages. They're good mortgages, except for 97% of them are bad, and they just put them all together into one basket and then rate all of them by the top 3%.
Well, it could be like what BMO claimed on their recent issue of a mortgage-backed security of $2 billion. They created that 95% of those mortgages in that portfolio was AAA. That means that it has the same rating as the Canadian government, which can print money to bail itself out. I don't believe those people can bail themselves out. And when it comes to actually rating something like that, you can't rate like people's mortgages the same as the country. You have to rate it slightly lower.
Well, folks, this is exactly what we saw in 2007, and we're seeing it repeat, and at a much more drastic scale, because this time when it comes down, everything was manipulated and put off. Look, I mean, back in 2008, the economy should have completely eroded to nothing, but the fact that it still continued on to this day goes to show how far down it's going to crash when it actually does, because the more they put it off, the bigger the crash becomes. And as we so often mention, that all fiat currency reverts to its true value of zero. It always has, it always will. We're going on the 1,000th year anniversary in 2024, going back to 1024 AD in China, of fiat currency, and it's always failed. It's failed hundreds of times. And then the same goes for the manipulation of the markets. Manipulation of the markets begets slight growth followed by incremental collapse, and it's something that we should all be warning about and very, very weary of, because we need to be able to protect ourselves, ensure our wealth in the inevitable crash of both the monetary system and the markets, which go hand in hand.
Well, all these debt that are unsustainable debt, I call it, which is borrowed against total crap assets. The problem with that is that you have a mass amount of bad assets that you're borrowing against, and you have to continue to borrow and borrow and borrow out more money to get more money in to feed the bad assets that you've been borrowing out, and it's an exponential cycle that you've seen. And if you go and look at charts of M2, M3, and all these other debts, if you look at the historical scale, you see like a hockey stick happening, and it's because of the unsustainable nature of debt when it accumulates upon itself and there's no growth. And of course, now, as the Federal Reserve said, there's going to be a 1.8 over 10 years. Well, the problem here, what you're seeing then, is the demographic of people are retiring there. We're seeing a deflation happening. And what's going to happen here is the massive bubble you're going to see, of course. Well, most of these bubbles that have been blown everywhere is debt. 90% of them is debt that have been blown up here, blown everywhere around the world.
Yep.
So what you're seeing is that massive collapse of all this debt that has been accumulating because there's not going to be enough money, enough people to pay back that unsustainable debt.
Well, you mentioned unsustainable, and I mean, that's one of the problems, though, is one of the very intrinsic problems with this situation is that these people think that they can sustain it via centrally planning the whole system, via manipulation, an artificial market, an artificial monetary system. That's one of the problems, is that it doesn't sustain itself on its own. It's sustained by man, which creates the unsustainability in the long run, which is the ironic part of all this.
There's people say, oh, usury is bad. I say compounding usury is terrible. The bankers, of course, invented it.
And it can be immoral.
And what's his name? Warren Buffett called it the eighth wonder of the world, compounding interest. And of course it is, because it is a fraudulent type of interest that you just compound on top of everything, so you make a lot of money. Now in this today's system, you have to, if you want to make money, you got to make it in compounding interest. And then when you borrow money in simple interest, which means it doesn't compound and you don't pay a massive amount of interest on it. You just pay a simple interest, which is basically the charge over a year. Let's say 100,000 and you had 7.5% interest, it would be 7,500. So that's what you pay. With compounding, it would probably be 15, way higher. Because the bankers have created this little scheme going where they can suck out a lot more money out of your pocket when you borrow money. So of course, again, this isn't sustainable, and it's got to blow. It's going to blow big time. I believe we're going to see the bubble that we're going to see now coming up, and it can't sustain itself for much longer. If they continue, the bubble is just going to be so big that it's going to be like a super volcano in Yellowstone, erupting and destroying North America.
And it'll fill the air with haze for many years to come, as a super volcano would. Yeah, absolutely. Us and our analogies. But so I think that would be the bottom line. So thanks, John, for going into this for us. And thanks for watching, everyone. You can check the links below. GoFundMe, Patreon. We can't do it without you. Any donation is very much appreciated, especially as we are so vastly demonetized and censored by YouTube. Also, check our Bitcoin address in the description and the comments, as well as on the screen for you to scan, if you please. And also check our link to the Red Pill Expo below in the description and the comments, which takes place in Bozeman, Montana on June 23rd to 24th, where you could see people like Robert Kiyosaki, G. Edward Griffin, Richard Gage, James Corbett, Jeff Berwick, Mike Adams, Ty Bollinger, Joel Salatin, Cynthia McKinney, and so many more incredible speakers. We hope to see you there. But until next time, this is Josh Sigurdson and John Sneisen signing out from World Alternative Media. Find the truth, be the change.